Hello and welcome to Chartmill. In this video we discuss the very popular MACD technical indicator. There is already a bunch of information available on the internet about this specific indicator, and also in our documentation section we have an article available that explains a bit more about the screen possibilities in Chartmill. In this video I briefly explain how the indicator is composed and how you can screen for certain MACD events in Chartmill. And of course, this indicator is by no means a holy grail system that only gives correct signals, and that's why I show you some techniques that will allow you to filter out a large part of the false signals. The MACD indicator is a so-called trend indicator. It helps traders determine the direction and momentum of the strength or weakness of a trend. The indicator uses the values of two moving averages, the 12 period and the 26 period moving average. The difference between the values of the shorter and the longer moving averages determines the reading indicated by the MACD indicator. These values are projected in a line on the histogram. Subsequently, the moving average of this MACD line is plotted in the form of a 9-period moving average signal line. The MACD indicator shows two lines based on the so-called MACD formula. The MACD line itself, which is composed of two moving average lines, the 12 and the 26 moving average, and then the signal line is a 9 periods measured average line of the previously mentioned MACD line. The lines of the MACD indicator are exponential moving averages, and they show the average value of the given period, but assigning a heavier weighting to the most recent input. First and foremost, the indicator tells us something about the direction as well as the strength of the trend. With an ascending MACD line, the trend is bullish, and with a descending line, it is bearish. The greater the distance between the MACD line and the signal line, the stronger the trend. If the MACD indicator indicates a strong trend, the price chart will show typically longer candles. Now, there are several ways to use the MACD indicator to generate trading signals, and the so-called crossover technical analysis technique is one of the most popular applications. The MACD crossovers of the lines generate a buy signal when there is a crossing of the MACD indicator line and the 9 periods signal line in an upward trend direction. A sell signal occurs when the MACD line crosses the signal line in a downward direction. The MACD is best used in a trend following system. With this indicator, you will never predict tops or bottoms exactly. However, the indicator does indicate whether a trend is losing strength or starting to gain strength. As with all other indicators, the MACD indicator cannot simply be used as a buy or sell signal on its own. It creates far too many false signals for that. For example, let's take a look at this chart of Momo Incorporated. The red vertical lines are sell signals, and the green ones are buy signals, based on the crossover of the red MACD line with the black signal line. While there are some good trades with a very decent amount of profit, many of these signals are completely wrong, leaving us with a loss or in some cases maybe a break-even trade. For this reason, the use of the MACD indicator is very controversial. Its opponents rely on the fact that the indicator lags behind the price and therefore gives late signals. Moreover, there are at least as many false as good signals, which makes the indicator rather useless. And while this is definitely the case if you use the indicator only on its own, but as with all other indicators, you need additional elements that confirm an MACD buy or sell signal. Unfortunately, there is a way to avoid a large number of those false signals. In this video, I show two of them. In addition, there are a number of other useful tools to increase the effectiveness of the MACD crossover. The first way to exclude false signals is to use the MACD indicator as a trend indicator on a higher time frame. Once again, we use the ticker Momo as an example, but this time we plotted the daily and weekly chart next to each other. Both charts start at the beginning of 2020, and in both charts we have put the MACD indicator below the price. On the chart on the right side, we notice a red marked area. This is the period that the MACD indicator showed a bearish trend. The red MACD line is below the black signal line. From July onwards, we see that the weak trend changes from negative to positive. The red MACD line crosses the signal line upwards, so from that moment we gave the chart a green backmark. Those bullish and bearish periods we then also marked on the daily chart on the left. Instead of keeping all bullish and bearish crossovers of the MACD indicator as before, this time in the red bearish section we only selected the bearish crossovers, so when the MACD line crosses the signal line downwards. In the following green period we only selected the bullish crossovers, when the MACD line crosses the signal line upwards. A few things that stand out. By taking into account the trend on the weekly chart, we retain much less signals. The signals that do remain valid include the biggest winners, including the short signals at the end of January and at the end of February. Only the bearish signal at the end of September, indicated by the blue vertical line, has disappeared because the weekly trend was still bullish at that time. Let's take a look at all the signals that are no longer valid by taking into account the trend on the weekly chart. That is 6 buying signals and 2 selling signals that were filtered out using the MACD trend on the weekly chart. However, the most important thing is that of those 8 signals, only 1 would have given us some money, the sell signal indicated by the vertical blue line. The vast majority of the remaining signals would have meant a loss to the account. So we keep in mind that just by taking into account the MACD trend on a higher time frame, the quality of the signals greatly improved. Just because crossovers of the MACD indicator, which are not in line with the trend on the weekly chart, are not taken into account. But even without using multiple time frames, you can avoid a lot of false signals by simply determining the long-term trend based on the price compared to a long-term moving average. In the article on the site about the MACD indicator, we use the Chartwheel trend indicator, but you might as well use a 200 daily moving average to determine the long-term trend. We assume that if the price is above the 200 daily moving average, the trend is bullish, and if price is below that same moving average, the trend is bearish. Because we only want to trade in the direction of the valid trend, we only keep the MACD signals that correspond to the current trend. An example using the ticker JD. On this chart we have added the 200 SMA. The green and red circles in the MACD indicator are all crossovers. Since the price in this case has been above the 200 SMA since October 2019, it means that we only take the buy signals and not the sell signals. Admittedly, this is a specific, well-chosen chart where the trend is very clearly rising, and in many cases the price chart will look a lot more erratic. But that does not change the fact that by taking into account the price compared to the 200 SMA, you would have consciously ignored all sell signals with this ticker since October 2019. Despite the fact that we have been able to avoid a lot of false signals with a trend filter, it does not necessarily mean that the remaining valid signals have to be followed blindly. In combination with a number of simple additional considerations, we can improve the quality of the MACD signal even further. The first step is to be very aware of the signals that occur in the immediate range of the moving average, in this case the 200 simple moving average. If the price has already risen sharply and is at a considerable distance above the 200 MA, the chance of a price drop is much higher than when the price is in the neighborhood of the 200 SMA. The chart of Yandex shows exactly what we mean. The second tip is to look for sideways price movements and price outbreaks from those ranges that match the MACD signals. Breaking through a significant resistance level is an important additional trigger that supports the MACD buy signal. Take a look at Qualcomm's chart, for example, in June this year. The price has been in a sideways range for several weeks and then suddenly rises by more than 6% on the 2nd of June. As a result, the sideways price channel that existed until then was broken, and the closing price of that candle was clearly above the 200 SMA that determines the long-term trend. At the same time, an MACD buy signal occurred. And third and final tip, specific candlestick patterns that occur at the same time as the MACD signal are an additional feature that can highlight the strength of the signal. The FBHS ticker, for example, where a bullish engulfing pattern suddenly forms in a sideways range close to the 200 SMA at the same time as an MACD buy signal. The next day, the price breaks out of the existing consolidation zone and rises sharply. The more of the above elements can be combined in one price chart, the stronger the MACD signal will be. Finally, I quickly go over the MACD filter options in Chartmill. You can find the stock screener in the left menu on the homepage. Under the tab Indicators, you select the MACD menu, where you can filter whether the MACD line should go up or down, or whether the MACD line should be above or below the zero line. You can even indicate whether the zero line should be crossed from above or below. Hopefully this video has given you some more insight into the MACD indicator. Like any other technical tool, the MACD indicator is just another tool with its own strengths and weaknesses. By using this indicator in combination with a simple trend filter and also taking into account clear support and resistance levels, you can avoid a lot of false signals, making the indicator a lot more reliable and therefore more valuable. That brings us to the end of this video. If you found this an interesting and useful video, we would greatly appreciate it if you would press the like button. And if you don't want to miss a single video in the future, be sure to press the subscribe button. In the comments below, you can ask additional questions about this video or make suggestions for other topics that may be covered in one of the following videos. Thanks for watching and see you next time.